Hope you're feeling relaxed because this first story will make you raise an eyebrow. Washington thought cutting Huawei off from American tech would be a clean kill. But instead of bleeding out, Huawei built an entirely new battlefield. And today, we're the ones trapped inside it. Because what began as a tactical strike is now exposing a weakness inside the West no one dares admit. And the way Huawei pulled it off could reshape the future of technology and power itself. Let's break it open. In May 2019, the US government placed Huawei on the Commerce Department's entity list, severing it from essential suppliers like Qualcomm, Intel, Broadcom, and Google. Secretary of Commerce Wilbur Ross described it as delivering a death blow to China's tech ambitions. The theory backed by major U.S. analysts from the Council on Foreign Relations was that Huawei, losing access to U.S. semiconductors and software, would rapidly deteriorate, dragging China's broader tech ecosystem down with it. The logic wasn't baseless. At the time, Huawei relied on U.S. companies for over 45% of its smartphone components, and its flagship devices ran Android systems critical for global sales. In June 2019, the Wall Street Journal forecasted that Huawei faces existential threats without U.S. chips. To Washington, policymakers, the blacklisting wasn't just a sanction, it was supposed to be a financial guillotine. But here's where things started slipping, because Huawei had already seen it coming years earlier. And what they did next didn't just save them, it gave them a weapon the West wasn't prepared to defend against. When the blacklist hit, Huawei pivoted faster than any Western analyst predicted. Internal sources revealed to Bloomberg that Huawei had spent $23 billion stockpiling critical U.S. components throughout 2018, well before sanctions were officially announced. By the time the cutoff came, they had amassed an estimated 18-24 months worth of inventory, enough to keep flagship production alive while they scrambled for replacements. Meanwhile, Huawei accelerated the deployment of its in-house high-silicon division, unveiling the Kirin 990 chip in September 2019. Although still dependent on Taiwan's TSMC, at first the Kirin series slashed Huawei's foreign chip reliance by over 40% within a year, according to Counterpoint Research. Software Harmony OS, an internal project dating back to 2012, was launched under emergency conditions. Within 18 months, Huawei shipped over 200 million devices running Harmony OS in China alone, according to Canalys's 2023 data reclaiming lost smartphone market share without Google services. The lesson here wasn't just that Huawei survived, it was that cutting them off made them more dangerous, because necessity fueled innovation faster than comfort ever could. And what Western analysts missed next would prove even costlier. One fatal error was revealed in late 2020 when Nikkei Asia reported that nearly 70% of Huawei's core suppliers had already shifted to domestic or non-US alternatives by the time sanctions fully bit. Analysts focused narrowly on short-term hardware disruption, missed Huawei's long-term strategy, rebuilding the supply chain itself. Experts like Chris Miller, author of Chip War, later admitted that Western assumptions about China's dependency were based on outdated 2016 to 2017 data before Huawei massively invested in indigenous R&D. Between 2019 and 2023, Huawei's annual R&D spending grew from $15 billion to $24 billion, surpassing Apple's research budget, according to Bloomberg Intelligence. Another critical oversight cultural miscalculation. The detention of CFO Meng Wanzhou in Canada, described by Reuters as a national humiliation, rallied political and consumer support across China. Suddenly, Huawei wasn't just a company, it was a symbol of sovereignty. And when patriotism collides with economics forecasts built on spreadsheets fall apart, the war wasn't over. It was only mutating, and the battlefield was about to shift in ways few outside Beijing could see coming. While American telecom giants staggered through messy 5G rollouts, Verizon and AT&T missed multiple deployment deadlines through 2023. Huawei pressed an advantage few realized they had been cultivating for years infrastructure mastery. In 2024, Huawei unveiled 5.5G networks, commercially offering peak download speeds up to 10 gigabits per second, ultra-low latency of zero point 0.5 milliseconds, and built-in AI-driven network slicing a staggering jump over conventional 5G capabilities. According to an Ericsson mobility report released in early 2025, Huawei's 5.5G deployments covered 28 cities in China and 14 foreign markets within 18 months. Meanwhile, U.S. carriers were still grappling with patchy 5G service even in major metropolitan areas like Chicago and Los Angeles, sparking customer complaints and lawsuits as reported by CNBC. The key Huawei had quietly invested billions into AI network optimization, terahertz communication research, and quantum-secure transmission trials fields, where the U.S. had no commercial-scale equivalents by 2025. What started as a fight over smartphones was now evolving into a total technology realignment. And inside Huawei, a far more radical plan was being drawn up, one that would permanently cut the company's dependence on anything American. A plan so extreme, it earned a chilling name inside Huawei's own corridors. In leaked 2024 internal memos obtained by Nikkei Asia, Huawei executives outlined Project Delete America, a scorched earth strategy aimed at purging all U.S. technology code components and dependencies from their ecosystem by 2025. At first, it sounded like corporate bravado, but the numbers told another story. By late 2024, Huawei announced its ERP system, Meta ERP, completely free of Oracle Microsoft and SAP software dependencies, handling 100% of its internal global operations according to SCMP. By early 2025, Harmony OS devices captured 23% of China's smartphone market, displacing Android's dominance, while Ascend AI chips built on Huawei's homegrown Kunpeng architecture began replacing NVIDIA's GPUs in Chinese data centers. It wasn't just a boycott. It was a civilizational firewall. And Beijing noticed. Under the Made in China 2025 initiative, Huawei's self-reliance model became the blueprint accelerating domestic chip fabrication efforts at SMIC, pushing new semiconductor alliances with BRICS nations and fueling government-backed innovation funds totaling $1.3 trillion across strategic sectors, as reported by Bloomberg in March 2025. Huawei's transformation wasn't just survival. It was a template for China's endgame: decouple first and dominate second. But what Huawei is quietly building next could shatter even these victories, and it's already starting to leak beyond China's borders. When Huawei unveiled the Mate 60 Pro in August 2024, powered by its own 7nm Kirin 9000 chip fabricated at China's SMIC, analysts at Counterpoint Research noted something alarming. Huawei clawed back 17% of China's premium smartphone market in just 5 months, displacing Apple's dominance. Qualcomm, once the titan supplying 65% of China's high-end smartphone chips, saw its Chinese revenues collapse by 55% year over year by Q1 2025, according to its SEC filings. But this wasn't just a Chinese story. Global markets felt the tremors. Southeast Asia's smartphone sales by Chinese brands surged 26% during the same period, fueled by Huawei's resurgence, while Qualcomm's broader international licensing revenue dipped 11% per Bloomberg. And beneath these numbers was a deeper problem. Huawei's comeback wasn't powered by U.S. tech. It was powered by Chinese independence. If American firms thought Huawei would quietly fade after sanctions, the numbers showed the opposite. And Qualcomm's nightmare, it wasn't isolated. A much larger trap was already snapping shut across the entire U.S. tech supply chain. In early 2025, President Trump authorized a sweeping 145% tariff on Chinese tech imports, aiming to crush Huawei, Xiaomi, and Lenovo with sheer price pressure. But by February 2025, the backlash was ferocious. U.S. laptop prices spiked 28% overnight, and Gartner reported that domestic PC shipments fell by 19% in Q1 alone, the worst contraction since 2013. Meanwhile, small electronics retailers sounded the alarm. The National Retail Federation warned in February 2025 that the tariffs could cost the U.S. economy up to 192,000 jobs within 2 years if exemptions weren't granted. Faced with mounting pressure from American businesses and voters, the White House quietly carved out exemptions for critical imports, including laptops, smartphones, and semiconductor components. By March 2025, a pivot Reuters described as a tactical retreat under economic duress. The irony: the tariffs meant to break Chinese tech dominance wound up entrenching it deeper into U.S. consumer markets. And the dependence was becoming systemic at precisely the moment Washington could least afford it. Today, despite the tech war, the data is brutal. According to S&P Global Market Intelligence, 31% of laptops sold in the U.S. in early 2025 contained Chinese processors, displays, or key components, up from just 18% in 2021. The Semiconductor Industry Association reported in March 2025 that while the U.S. spent over $52 billion on CHIPS Act subsidies, 58% of America's low-end fabrication equipment still depends on Chinese vendors like Nora and Amic. And the consumer side tells an even starker story. Best Buy's internal inventory memos leaked to Business Insider showed that over 40% of entry-level laptops and smartphones sold in the U.S. now featured Chinese-designed motherboards, chipsets, or screens. Cutting China off wasn't just failing, it was creating deeper entanglements. The Wall Street Journal editorialized in April 2025. The U.S. tech sector is now more intertwined with Chinese manufacturing than it was before the sanctions began. What was once framed as strategic leverage is morphing into strategic vulnerability. And as the gap widens, it raises an even harder question Washington doesn't want to answer. By 2025, the outcome was undeniable. Rather than collapsing, Huawei reemerged as a Chinese resilience and America's inability to predict, let alone prevent, rapid adaptation. Data from Bloomberg shows Huawei's overall revenue jumped by 14.2% year-over-year in Q1 2025, with smartphone shipments up by 64% inside China, and by 22% internationally, driven by Middle Eastern and Southeast Asian markets eager to adopt non-U.S. alternatives. Meanwhile, American firms caught between sanctions, compliance, and market survival faced an ugly bind. Qualcomm, Intel, and Micron all warned shareholders of long-term strategic risk in China, per their latest SEC filings. At a structural level, China's National Tech Self-Sufficiency Index tracking domestic component use in critical sectors rose to 78% by early 2025, up from 46% 5 years earlier, according to Kaishan Global. The gamble to cripple China's tech sector didn't slow it, it forced it into hyperdrive. And now, as Huawei exports its playbook across China's AI, quantum, and fintech sectors, the real cost of miscalculation is starting to hit home. Because if technology was supposed to secure America's dominance for another century, this war may have just accelerated the handover. But if you think Huawei's revenge was limited to smartphones and 5G towers, you're missing the bigger storm brewing right now. Because China isn't just aiming to replace Silicon Valley, it's quietly building a parallel global financial system. And soon, even the US dollar could find itself fighting for survival. Stick around, because what's coming next makes the Huawei comeback look like the opening move. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.